Kenya's political landscape is heating up, and the streets tell the story. We are witnessing more protests, and sadly, businesses are bearing the brunt of the damage. It is a grim cycle as this distraction threatens widespread job losses that could cripple livelihoods. This escalating unrest is not just a political problem. It has a significant impact on the economy. And when the economy falters, it is the ordinary person who feels the sharpest sting in their personal finances. Mint aims to provide you with valuable insights to help you earn, save, spend, and invest your money wisely, especially during these challenging times. Stay with us. My name is Lydia Nyawera.
Earn it, spend it, save, invest. Earn it, spend it, save, invest. Mola, kila siku niko chesa. Mola, make more bila stress. Mola, kila siku wesa. Mola, make more bila stress.
Today on Mint, understanding your investments. What factors can boost or dip your returns? Your financial dynamic duo. Why sinking funds and emergency funds are essential for your financial stability. And on Coins to Capital, Kijani Curlcare is a true testament to turning personal needs into impactful capital.
Earn it, spend it, save, invest.
You've invested your money in unit trusts, hoping to see it grow. Last week, we explored what happens behind the scenes when you invest in unit trusts. But have you ever wondered what exactly determines the interest you earn? Today on Money Moves, we will discuss the various factors that can significantly affect your earnings from unit trusts. Understanding these influences will empower you to make more informed decisions and potentially increase your returns.
Before you commit your hard-earned money to any investment product, you are always reminded to do your due diligence. Even investments that seem incredibly safe like unit trusts carry risks. So, when considering unit trusts, it is strongly advised that you research and evaluate all factors that could potentially affect your earnings.
The element of risk comes about on the interest rate risk, in that this week's interest rates on treasury bills will be different from next week's or even next month's or even the next 3 months. So you find that the interest may fluctuate, but not to a great degree.
Equity funds are considered risky because they offer no guaranteed returns. The value of an investor's money is directly tied to the performance of the underlying businesses, which operate in a highly competitive and unpredictable market.
So say you bought the Safaricom, we've invested for our clients in Safaricom, and we bought their share when it was at 15 shillings. Then we find that next week or even the following day, the share price has gone to 14 shillings. There is that 1 shilling drop in the value of the asset. So you find that the value of the equity fund fluctuates much more than it would for the money market fund. The performance of the shares in the Nairobi Securities Exchange affects a lot on how the equity fund performs. And you find that if a share is performing poorly, or rather the share price is suboptimal, you find the company might not declare dividends that year or might declare a lower dividend. So you find that for equity fund, you earn through dividends and capital growth. So you find that dividends for that half year may not be there or might be reduced. So this is how the risk affects the equity fund, and also the market conditions at the Nairobi Securities Exchange. This is what affects your return on the equity fund.
Like equity funds, bond or fixed income funds also have their assets traded on the Nairobi Securities Exchange.
What really affects performance of the bond fund would be the interest rates, or the prevailing interest rates at the Nairobi Securities Exchange, because bonds are traded at the secondary market of the Nairobi Securities Exchange. So you find that if interest rates are high during that period, rather that period of time, that means consequently your earnings on the bond fund will also be higher because of the increase of interests. So there are different scenarios where you find that the interest rates go up or go down, and these are also subject to other economic factors such as inflation.
Different seasons also mean different earnings for unit trusts.
Minimum investment for treasury bills, treasury bonds is 50,000. But I find that most people, they may not have that amount to invest. On a weekly basis, there's a treasury bills auction. On a monthly basis, there's a treasury bonds auction. So the roundabout way around it, fund managers is now collecting monies from people as low as 500 shillings, aggregating and now investing in those treasury bills. So that's where the money market funds comes in. So that's where they invest in. As a result of what we saw over between 2023 up until September last year, where treasury bills were around 15%. And imagine a money market fund investing in treasury bills. So that means even your investment in money market fund is around that 15%. The money managers were also investing in fixed deposits. Remember, this is a time where central bank rate was at 13%. Central bank rate is at 13%, and now for banks, they were lending at around 18%, but they're lending with money from you and me. So, but now to attract your money, my money, banks, they could offer, say, fixed deposits, say 15% or whatever, so higher. So even the money market funds were investing in those fixed deposits. So if you look at it, somebody who is managing a money market fund, you have treasury bills at around 15%, fixed deposits around 14-15% thereabout. You put the match. So that's where the money market funds then were around 15% thereabout. But because treasury bills have now started coming lower, as they get money, they are buying treasury bills at lower rates. Banks now, because central bank rate has also come lower, there's no justification now to give deposits at crazy rates. So they're also gradually reducing. So even from the portfolio mix, treasury bills has come lower, fixed deposits has come lower, so even what they're investing in is offering lower rates.
Unit trusts in Kenya are experiencing impressive growth. That's a positive trend for savers and investors. However, don't jump in blindly. Take the time to deeply understand each fund. Your thorough research will lead to truly informed investment decisions.
Earn it, spend it, save, invest.
We all know the drill. Be financially prepared. But let's be real, life happens. Impulse buys call your name and then bam, an unforeseen expense hit. Suddenly, your financial stability is on shaky ground. That's precisely why you need a dynamic duo in your financial corner, a sinking fund and an emergency fund. Dreaming of that new car or a big vacation? On Money Hacks, we'll show you how a sinking fund is your strategic first step to making those large purchases a reality without the stress.
In life, one should always be financially prepared for any situation. However, spontaneous purchases and unforeseen events can disrupt one's financial stability, highlighting the importance of a sinking fund and an emergency fund. To comfortably make large purchases, the first step is to plan for them using a sinking fund.
A sinking fund is a pool of money that is set aside for a specific goal. And the main reason for sinking funds is to avoid emergency need of large sums of money. When you look at it historically, it traces itself back to the 13th century with Italian city-states, where they would want to set money aside to meet their debt. And it was picked up in the 18th century by Great Britain and later on became popularized with the United States.
For unexpected events, on the other hand, an emergency fund comes in handy.
So, definition of emergency funds has it being a pool of money set aside for no specific goal, but it has that aspect of it expecting, let's say, 2 or 3 months of your normal expenses. It has to cover that. Emergency funds traces its roots way further with the pre-historical history of men, with the agricultural history, where they would set aside surplus food for unexpected weather conditions in future.
To secure your financial independence, it is important that one does not merge the sinking fund with the emergency fund.
One reason why someone would want to have both a sinking fund and an emergency fund would be for peace of mind. You can imagine knowing that you can meet day-to-day unexpected events coming up, you would sleep better. The other reason would be for budgeting efficiency, because with sinking fund, you know an X amount of money on a given period of time is needed to be injected there. Now you can efficiently allocate your income based on the needs that you foresee. Again, the other reason would be in terms of getting clarity and demarcating your money. There's a common problem that people have, which is mental accounting. You just know I have X amount of money, in there is rent, in there is emergency, in there is, say, a car that I'd want to buy 3 years from now. But then once you separate, you remove these risks that come with mental accounting.
It is important to note that having both funds will require some level of planning on your part. This is often guided by your priorities.
One of the most efficient ways has to be sticking to a budget. First, looking at your day-to-day expenses, then from there you'll see the surplus that you have. Then next would be what comes first. Do you already have an emergency fund in place? Then a sinking fund will come next as a priority. But then if you don't have a sinking fund, the question of the egg and the chicken, which comes first, you'd have to set up the emergency fund. So budgeting will be key, and second to budgeting is sticking to the budget, which is one difficult word called discipline. Sticking to your budget and narrowing down miscellaneous expenses. An efficient way of minimizing inefficiencies with budgeting would be by ensuring you have a check-off system, which enables you to automate your allocation towards, say, your emergency fund and your sinking fund.
To ensure each of the funds serves its purpose, separating them is the best approach.
While combining the sinking fund and emergency fund sounds easy and quite simple in terms of dealing with monies, it carries the risk of mental accounting, where within my larger 300,000, 200,000 is channeled towards my education needs, 100,000 is just for unexpected. You'd find moving and putting your fingers into the cookie jar is easier because all this lump sum is in one. To really stress in and push the boundaries with discipline and consistency, putting them separately will be key.
To add value to the money you save, consider financial instruments that can boost its worth.
One of the things about both funds that you should take advantage of is interest, and this comes in by investing. You'd find with interest, first, it shields you from that risk of inflation, and second, it gives you that benefit of compounding, because in addition to your principal is bringing in some little babies over a period of time.
Building these funds does not require a lot of money. You can start with any amount.
You can always start from somewhere. There is no set limit, say even 50 shillings a month, all the way up to 50 million a month, depending on your financial capabilities. You can always start somewhere. And a journey of 1,000 miles, as they say, always starts with one step.
Now you see the value of the financial dynamic duo, the sinking fund and the emergency fund. You can save for your dreams while building a safety net for life's surprises. This is a new take on financial preparedness. Now, let's take a quick break. From dance challenges to a powerful platform for micro entrepreneurs, Kenya's MSMEs ripping it big on TikTok.
Earn it, spend it, save, invest. Mola, kila siku waste that mola, make more bila stress.